Joining us right now is Jason Furman. He served as the chairman of the Council of Economic Advisors under President Obama. He is now an economics professor at Harvard's Kennedy School of Government. And Jason, you've been very outspoken for quite a while that the Fed wasn't moving fast enough to address inflation. You wanted them to raise rates. What do you think now that they raised rates at this last meeting once again and that the financial crisis is kind of lying in the background?
Yeah, look, there's the macroeconomy and there's the financial system. We haven't learned anything new about the macroeconomy that's particularly reassuring in the last 3.5 weeks. We know that inflation is running at about a 4.5% pace. We know that the economy is probably growing faster than its potential. We know that that's just a really, really big task to get from here to where we need to go on inflation. The banking turmoil is going to do part of the job, but as of this moment, it looks like it's only going to do part of the job. And the Fed's going to need to do more itself as well.
Okay, you point out, looks like inflation's running at about 4.5%. The expectations for this PCE number that we get at 8:30 this morning is 4.7% year over year. The market's going to look at this and say, okay, if it comes in line with that, it's not too bad, don't worry. But you're saying even if it does come in line with expectations, it doesn't matter. The Fed still has to hike rates more.
Yeah, I mean, there's an issue like, what do you expect right now at 7:15 a.m. or whatever it is for an hour from now? That's not that big a thing. Of course, we're not going to be hugely surprised, or not of course. We probably won't be hugely surprised. But let's step back. 4 months ago, we were expecting that we'd be at a pace of inflation of more like 3% in the first quarter of this year. That's really changed pretty dramatically to where we are now. And that's why the Fed was, I think, on course to do 50 basis points at the last meeting. I think they made the right call to dial that back to 25 in light of the banking turmoil. I think the main question between now and the next meeting is going to be how much work is the banking turmoil doing. I think the macro data, we'll get the inflation numbers for March before the next meeting. I think they're going to be high, too.
Hey, Jason, let me just ask. Just wondering what's happened. It seems like things have stabilized a bit for the moment when it comes to the banks. We haven't heard about any emergency meetings from last weekend. We're hoping there aren't going to be any this weekend either. But when you talk to people who are digging in the markets and poking and trying to find areas of weakness, they'll point not only to the banks, but other places that they think that this could potentially spread, the contagion beyond that. They look at commercial real estate. They look at insurance companies that have a lot of commercial real estate or other assets that they've been holding at some level that may not be realistic in terms of the marks. And that may be the concern and may be a reason for the Fed pausing, just to say, let's see what happens. If we continue to push this, you could push it to the point of lots more things breaking, and that could be more than the Fed is even wanting to do in terms of a break to the economy.
Look, if we're starting to see this turmoil spread within the financial system, I think a pause would be perfectly appropriate. If we're not, I think a pause would be a mistaken way to try to increase financial stability for two reasons. First of all, if eventually you're going to need higher rates and you lure investors into a false sense of security that the Fed funds rate's not going up, you're just increasing the chance that you're coming back and surprising them later. Second, higher inflation means higher interest rates. That means financial instability. You can't have a stable financial system without getting the macro under control. So absolutely, they should monitor, they should be careful, but they shouldn't be aggressive in holding off on rate changes for fears of financial stability. They could make the problem worse if they did that.